Okay, good afternoon, ladies and gentlemen. Welcome back to this weekly market review. As usual, I have my co-host with me here, Mr. Gerald Wong. So we are now in the Black Friday, Cyber Monday weekend. So, how have your shopping been, Gerald?
Haven't actually been doing much shopping over the past weekend. But I hear from the various people that I speak to that the town was very crowded. As many people were probably buying their Christmas presents.
Yeah, seems like the economy is still doing okay. People are still buying things and boosting our economy, especially our back end colleagues. We shared with us just now that Orchard Road was very crowded. So I think the bonus this year might be something that we are looking forward to. So on top of that, yeah,
Definitely.
on top of that, I think we need you today to help us to break down what is happening in the market for the past week, and is there any opportunities that we are looking out for?
Okay, so I'm going to share what has happened in the market over the past week. But before we start, just a disclaimer that today's sharing is for information purposes only, and it should not be taken to be financial advice. We also have one last upcoming SIAS on the 13th of December. This is a members only event. So if you would like to really take a evaluation of your portfolio, understand how some of the stocks have moved over 2023 and prepare for the year ahead, do join us for this upcoming session. And then if you find our sharing helpful, do leave us a review on Google. If you're wondering how you can join SIAS as a member, do go to this website or scan the QR code. The membership for SIAS is only for $12 per year, or working out to be less than $2 per month. Okay, so I will start by giving an update on the market over the past 1 week. And I think the good news that is driving some investors' positive sentiment is that the US markets have still continued to do well. The S&P 500 was up another 1%, now reaching close to the 4,560 levels. And if you look at the Nasdaq and the Dow Jones Industrial Average, both of these indices actually saw gains as well. But in the Singapore market, we actually saw slight decline. The STI dipping back to below 3,100 again, with the 1% decline over the past week. Okay, so this is a continuation of the trend where we see the STI actually performing worse than the US market. Okay, in terms of what are some of the key trends in the market, I think what has become very evident is that the US bond yields have continued their trend of decline that we started seeing since early this month. So just as a recap, we had the Fed meeting on the 1st of November, where investors actually gained confidence that the Fed might be close to the end of its rate hike cycle. Thereafter, we saw various economic data points such as the US Consumer Price Index that actually continue to show signs of moderation. So that has actually led to the decline in the US government bond yields. If you look at the 10-year government bond yield, at one point reaching 5%, this was in late October. But if I were to look at the latest data point, it is now below 4.5%, at about 4.47% as of Friday. Okay, so a 50 basis point decline in the time span of a month is actually a very significant decline, and that has continued to help boost sentiment towards the stock market. Okay, if you were to look at the Singapore bond yields, what would that actually tell us? It is actually quite a similar picture. In fact, if you look at the decline, it is actually even more dramatic decline. Okay, so once again, at October, it reached a high of about 3.5%. Okay, this is the Singapore 10-year government bond yield. Okay, if I were to look at the latest data point, it is now below 3%. So likewise, a 50 basis point decline in the span of a month. And actually, sometime in the past week, it reached as low as 2.93%. Okay, so the decline in the 10-year government bond yield is something that we need to be looking out closely for. It has helped to drive sentiment towards the stock market. It has affected the performance of bonds. And if you are looking at, say, the Singapore savings bonds as an example, then there's something that will affect the interest rates on the Singapore savings bonds going forward. Okay, so in terms of the top performers in the Singapore market, we see that the REITs are continuing to do well, with Frasers Logistics and Commercial Trust up by 2.8%, Mapletree Industrial Trust up by 2.2%. Okay, so the fall in the 10-year government bond yield has continued to boost sentiment towards the Singapore REITs. Outside of the REITs, we saw Emperador up by 2%, Hong Kong Land up by 1.8%. This is driven by improved sentiment towards the Chinese property stocks. And then if you look at SIA, up by 1.1%, this really driven by the fall in oil prices. Okay, if you recall in the previous weekly market review, we actually shared that SIA has oil prices as a very significant part of its cost base. So as oil prices started to come off, we started to see SIA share price continuing to rebound. In terms of the top losers, it is really companies that are seen to be benefiting less as the 10-year government bond yield starts to decline. We see here the banks starting to underperform, with OCBC down by 2.3% and DBS down by 2.7%. We also see Singtel down by 3% due to various news flow around its Australian subsidiary Optus. And then we have got DFI Retail Group down by 3% and ST Engineering down by 3.1%. Okay, so some of the more defensive names actually starting to come off as investors actually gain more confidence around the economic recovery as the 10-year government bond yield comes down. Okay, so a few names that I'll talk about today, these are really the ones that we have seen a lot of investor interest and also the share price having a bit of a movement over the past week. Okay, so one of the stocks that we are commonly getting questions on is DBS. You actually see this sharp decline over the past few weeks, from $34 to actually 31.82 as of Friday's close. Okay, so this is despite the strong results that it actually reported in the third quarter. Okay, so let us do a quick recap around how DBS earnings have been based on its third quarter earnings. I think what investors have taken more positive feedback on is really the improvement in its net interest income. If you look at the net interest income, it reached about 3.5 billion in the third quarter of this year, which is an increase from the second quarter as well as the first quarter of this year. Okay, so if you look at the group net interest margin, it has actually been increasing over the past 2 quarters. So this is actually something that the bank has been able to benefit from as interest rates actually continue to go up. Okay, and if you look at the commercial book, the net interest margin has actually increased steadily from 2.69% in the first quarter to 2.81% in the second quarter, and in the third quarter rising further to 2.82%. Okay, so the strength in the net interest margin is definitely something that has been driving the stronger performance of DBS. But then at the same time, as the interest rate starts to come off, investors are concerned that this trend of improving net interest margin would actually start to reverse going into 2024. And likewise, based on the guidance provided by the company, there are concerns that this net interest margin might not actually stay as high as where it is now going into the next year. The other area that has been positive for DBS is really this fee income. If you look at the fee income, it has been growing in the third quarter of this year compared to the second quarter, as well as the third quarter of 2022. Okay, this is driven by a broad base of segments within the fee income, whether is it in terms of the wealth management, which has grown fairly strongly to about 393 million of revenue in the third quarter, or actually in terms of the cards, where it has actually seen growth in terms of its fee income as well. Okay, and I think for a lot of investors, what they are looking out very closely for would be the dividends for DBS. Okay, so in the third quarter, it actually announced a dividend per share of 48 cents. Okay, so compared to the previous year, we see this growth in the dividend per share of DBS. So investors are looking out very closely for the fourth quarter results to see whether we'll see a further increase in the dividend payout, and whether it will also potentially pay a special dividend, just like what it managed to do in 2022 with the very strong profits as well as returns. Okay, so with the increase in dividend payout, what we see here for DBS is that the dividend yield is actually higher than the historical average. Okay, if you look at the current dividend yield, it is now at about 6%. Compared to the historical average dividend yield of about 5.3%. Okay, so the increase in profit as well as the increase in dividend per share has also helped to boost the dividend yield of DBS, and that is something that is helping to support the share price. Okay, but in terms of what is seen to be slightly more negative would be the valuation of DBS, and this especially from a price to book perspective. So if you look at the price to book of DBS, it is now at about 1.45 times at the upper end of where it has been trading over the past 5 to 6 years. Okay, if I look at the average over this period, probably at about 1.2 times. So because of the higher ROE that DBS has been able to generate, investors are actually willing to pay more based on the price to book valuation that it is now trading at. So one of the potential risks would be if the returns start to come off, then given that the price to book valuation now is at the upper end of the historical average, there could be a chance that that could potentially come off as well if the returns actually start to weaken. Okay, so in a nutshell, that is really what is driving the earnings of DBS and why the share price has come off slightly over the past 1 month due to the fact that investors are concerned that the net interest margin could come off as interest rates start to weaken. And then if you were to look at the price to book valuation, it is actually trading now at the upper end of the valuation range. Okay, next, a company that's been in the news a lot over the past week, Singtel. What you see here in terms of Singtel is that effectively you have got a very diversified earnings base. Okay, so for those who are not familiar with the company, you might know that it is very strong in terms of the Singapore operations. But if you were to look at some of the other markets that it operates in Australia, it is number 2 in Australia as well. It also has got operations in, say, Indonesia through Telkomsel, Thailand through AIS, in India through Bharti Airtel. So effectively, we not only need to keep track of what is happening in the Singapore business, but also what is happening regionally, of which some of the developments in Australia has actually led to the weakness in Singtel share price over the past few weeks. Okay, so using Australia as an example, it's got 10.4 million customers there with a 31% market share. And that is something that with its recent outage has actually disrupted quite a number of customers. And that is what investors are concerned about. Okay, so if we were to take a quick look at Singtel's recent earnings performance, what you see here would be what it reported in the most recent results, okay, which is for the first half of the recent fiscal year. If you look at the revenue, it has been able to grow it on a constant currency basis, but because it has got these businesses in some of the regional markets, once this revenue gets translated back into Singapore dollars, because the Singapore dollar has been very strong, so that actually led to a decline in its operating revenue on a Sing dollar basis. Okay, and likewise, if we were to look at the earnings before interest, taxation, depreciation, and amortization, which is the EBITDA, on a constant currency basis, it is down slightly by about 1%. But once you take into consideration the currency effects, then it is 5% down compared to the previous year. Okay, what has been strong is the performance of the regional associates, where if you were to look at it from a Singapore dollar perspective, it was still able to grow it by about 3% compared to the previous year. Okay, so once again, this is effectively how we can also look at Singtel in terms of the breakdown, in terms of the core business. There is the business in Singapore as well as in Australia through Optus. There are various growth engines that the company has identified, including NCS as well as the digital infraco. And then you have got the different associates, which I mentioned has actually performed well. And this will include its businesses, where it has got less than a 50% stake in Thailand and in India, as well as in other markets. Okay, so if you're to look at the performance of its Australian subsidiary, what you see here is that actually the revenue was higher on a year-on-year basis at about 4 billion Australian dollars. Okay, so actually the revenue that it generates from the Australian business is higher than what it generates in Singapore. Okay, if you compare this 4 billion Australian dollars with this 1.9 billion Sing dollars of revenue in Singapore. But if you look at the EBIT in Australia, then it is actually weaker, just at about 141 million Australian dollars and down 14% compared to the previous year. Okay, the Singapore business is down slightly less by about 4% to 442 million Singapore dollars. Okay, in terms of the growth drivers that the company has identified, we mentioned earlier that it is from NCS as well as the data center assets that it might have. But apart from that, the company also looking to enhance the capital structure of the company. And with that, it is looking to actually divest some of these non-core assets. So what you see here is that over the past year, it has embarked on some of this initiative to be able to generate more cash flow for the company. Okay, so with that, we see that being reflected in the dividend payout of Singtel. Okay, we saw this decline in 2020 and 2021. Okay, but since then, it has actually been able to grow its dividend once again after what it calls a strategic reset. Such that in FY23, it was able to pay a dividend per share of 14.9 cents, and increase from the 9.3 cents in the previous year. Okay, so in case you're wondering what Singtel's dividend policy is, what they intend to do is to pay between 60% and 80% of the underlying profit. And what it has also mentioned is that if there are any excess proceeds from its capital recycling initiatives, after they have been put aside for funding growth as well as the repayment of debt, then those are potential capital that it can pay out to shareholders as well. Okay, so in terms of what to look out for, what is happening in Australia, given that it is a big contributor to its profit, we also need to keep a lookout for some of its growth initiatives, as well as its ability to recycle capital, since that will affect its dividend payout. Okay, so what you see here, like I mentioned earlier, is the growth in Singtel's dividends over the past 2 years. Okay, last but not least, one of the REITs that we have gotten quite a number of questions on, and also like we saw earlier, the top performer of the STI in the past week. Okay, so Frasers Logistics and Commercial Trust, if you look at the share price, it has had a very strong bounce, okay, from below 170 to closing at 187 on Friday. So that's more than a 10% bounce over the course of the past month. Okay, so for those of you who are not familiar with Frasers Logistics and Commercial Trust, effectively this is a REIT with exposure towards various logistics and commercial assets. If you look at the breakdown of its portfolio, logistics and industrial assets will make up about 70% of its portfolio. Thereafter, it has got various suburban office as well as business parks, which makes up about 22% of its portfolio, and then CBD office at about 8.5%. Okay, if you look at the breakdown of its assets, Australia would be the bulk of its assets, okay, at about 51%. Okay, thereafter, it is quite evenly split between Singapore and UK at about 10%. And then you've got Germany at 24% and Netherlands at 5.2%. Okay, so another Singapore listed company with very big Australian operations, just like what we see for Singtel. Okay, so if you were to look at the recent performance of Frasers Logistics and Commercial Trust, it has got a September year end, so it has reported the full year 2023 results. Okay, we see a slight dip in the revenue. That is because of some of the FX impact, given the big operations that it has in Australia. Once again, once that gets translated back into Singapore dollar, we get the decline in the revenue in FY 2023. Okay, on top of that, we see some of the higher operating expenses because utility bills have actually gone up. So the adjusted net property income has come down further. The finance cost has gone up slightly, okay, but not as much as what we see for some of the other REITs. And with that, the DPU actually declined by about 7.6% compared to the previous year. Okay, so I mentioned earlier that the revenue came off. If you look at the portfolio occupancy rate of Frasers Logistics and Commercial Trust, still fairly resilient at 96% for the entire portfolio. In particular, the logistics and industrial assets are doing well with 100% occupancy, but the commercial assets have slightly lower occupancy at just about 90%. Okay, in particular, there are two assets that have seen a decline in occupancy over the past 1 year, including this 357 Collins Street in Australia, where the occupancy has come down from 94% in September 2022 to just about 84%. Okay, and likewise, if you look at the Maxis Business Park in the UK, coming down from 100% to 79% as of 30th September. But because these are relatively small assets, okay, if you look at the contribution to the portfolio, 357 Collins Street is just about 3.5% of the portfolio. This business park in UK is just about 1% of its portfolio. So as a result, it's been able to still have a very high portfolio occupancy rate of 96%. Okay, and then lastly, in terms of the gearing of Frasers Logistics and Commercial Trust, what we see here is that while the aggregate leverage has gone up slightly to 30.2%, okay, this 30.2% number is still lower than what we see for most of the other REITs, which is why even though the interest rate has gone up, we do not see a very sharp spike in Frasers Logistics and Commercial Trust borrowing costs. Okay, so if you look at the cost of borrowing as well, it's gone up slightly from 2% as at 30th June 2023 to 2.2% as at 30th September 2023. But on aggregate, there's no sharp spike in terms of the total finance cost of Frasers Logistics and Commercial Trust. Okay, and if you were to look at the valuation of Frasers Logistics and Commercial Trust, because the portfolio occupancy has still been relatively strong, because it is one of the REITs with a fairly strong balance sheet. So I guess in terms of the performance of Frasers Logistics and Commercial Trust, it's been fairly resilient. Okay, still trading at about a price to book of 0.95 times, slightly above the historical average, compared to some of the other REITs where we have seen a sharper decline in terms of the price to book valuation. Okay, so with that, I've gone through some of the major movers in the Singapore market over the past week. In terms of what we are looking out for this week, we have the application closing date for the latest issuance of the Singapore Savings Bond. Okay, so I mentioned earlier that the 10-year government bond yield has started to come off. So if the Singapore Savings Bond is still something that you are looking at and are interested in, be aware that the closing date for the December issuance is actually today, 27th of November. Okay, we also have a number of corporate connect organized by SIAS that are coming up. There's one that's happening tomorrow on the 28th of November with Elite Commercial REIT. So if you are interested in REITs, do join us in a session where we'll be able to understand more about the company. Last but not least, we have been talking about specs quite often in the various weekly market review. The EGM for Vertex spec will be held this Friday on the 1st of December. Okay, and just as a final reminder, if you want more information on the VTech DSpec, scan this QR code where you'll be able to view independent research relating to the VTech DSpec, which have been published on the SIAS website. Okay, so with that, I'll hand over to Sunny, who will share with us some of the technical indicators and what to look out for amongst these technical indicators.
Okay, thanks, Gerald, for the timely sharing on some of the constituents of our STI index going to the end of the year. So, look out for to sort of plan our portfolio or readjust our strategy towards. So, for me, I think I'll touch on the major indices indications that we are looking at for the major indices. Let's look at the STI index first. So like what Gerald mentioned just now, STI is the down 1% for the whole of last week. And on last Friday, we also saw quite a thin volume. And last Friday, the index actually dropped by about 0.5%. So this morning, on Monday morning that we are seeing, STI is still pretty flat, just down 2 points. So we are still looking for a direction for the STI index. But doing a bit of recap for the year, definitely we are lower than where we begin at the start of the year. And looking at the different levels that we are into right now, the STI index seems to be going into a consolidation level at this buying zone that we have identified earlier, which is between the March low of this year as well as some double or triple bottom during the middle of the year. So where is STI likely going to head from here? Looking at both, we are seeing that the MACD indicator is starting to turn negative today. So that is a bad sign. And both the MACD line and the signal line are below the zero baseline. So all these two indications on the MACD indicator is telling us that the momentum or the trajectory that the STI index is going is likely going to be weak and likely going to go slightly lower again. And on the RSI, the latest reading at 42 is also below the 50-point neutral mark, as well as the 14 days moving average of the RSI at 47. Other indication that we are likely going to see very weak momentum or coming in to the STI index. So where is STI likely going to head into the next few weeks towards the end of the year? Besides this the March low that we observed this year at around 3,100 points level. Below this, we also have the June low of last year, which is around the 3,070 points or 3,060. So that is the next support level that we are going to look at. If we break this level, then the next one would definitely be the lower bound of the Bollinger Band at around 3,050 points level. Of course, year-to-date low, we are looking at 3,000 and 3,040 points, which is the year-to-date low that we see in end of October this year. So STI going to a consolidation mode over here. So we'll likely be looking for a catalyst of both of these downtrend line that we observe for the most part of this year. Okay, so looking out for this downtrend line, when it hits this, we'll likely see some resistance and consolidation around this area, and then we see how it will perform again next year. So taking all this into consideration, I think last Friday trading volume was actually pretty weak as well, pretty thin as well. So I think that there should not be much of a movement on the STI index, and we should consolidate around this area, around the 3,100 level plus minus, and probably the closing to end of the year, I am projecting probably 3,100 would likely be where we are likely going to close around for the end of December. Okay, so next let's move to the major US indices. So for the US index, we see a very strong one in November, especially after we reached a bottom in the end of October for the Dow Jones index at least, where we reached a low of around the 3,200 and 32,300 level. We see a very big rebound in the month of November. So this rise has actually starts to go towards the year-to-date high already, which is around the August period. The highest that we've seen for Dow Jones index was 35,679 points. And now we are at 35,390 points. So we are more or less about 100 or 200 points away from the year-to-date high. And that is where I think index is targeting to finish or looking to retest towards the end of the year, especially for the December FOMC meeting, where the market projection is we are expecting no more cuts, and that could be a further upside news for the Dow Jones index to retest the year-to-date high at 35,679 points. Looking at both of these indicators, you can see that MACD is showing very strong positive momentum and very strong positive signs. Both the MACD line and the signal line, the trajectory is still very the angle of attack, I would say, is still upwards, and that kind of angle is showing that the strength of the Dow Jones Index is likely going to be very strong going towards the end of the year. Okay, the gap between the MACD line and the SIG line is still healthy. That means we do not expect a crossover, hence a change in direction in the Dow Jones Index. So probably Dow Jones Index will stay toppish around the 35,400 level. However, on the RSI, we have already breached the 70-point overbought mark, and observing what happened earlier around the July period where the RSI hit a high of 75 points. After that, the Dow Jones Index starts to have a bit of retracement over here during the July-August period. So RSI is telling us that we may be close to the peak of where the momentum is right now for the Dow Jones Index, and hence there might be some kind of pullback, retracement, or consolidation happening for the Dow Jones Index. So with these readings on both of the indicators, I would say probably the upside that we are looking at for the Dow Jones Index will be likely be kept at the year-to-date high around the 35,679 points level. And if we have a pullback happening, the first one we are looking at maybe this small double top over here at 34,970 points, or the 35,000 handle will likely come in to provide some support for the Dow Jones Index. So more or less, much of the gains for this year on the Dow Jones Index has already been baked in, and I don't think that there will be much of a movement coming into the end of the year for the Dow Jones Index, and we are targeting to finish close to the year-to-date high at 35,679 points. For S&P 500, a very similar pattern as compared to the Dow Jones Index. We have a very strong November as well, and we are now at 4,559 points. Year-to-date high, let me just put the line over here. Year-to-date high is around 4,607 points. So we are about 50 points away from the year-to-date high for the S&P 500. So the same thesis may also play out on the S&P 500. If we see a confirmation that we are not seeing any rate high in December, then probably we will test this year-to-date high, 4,600 points, and then there might be some kind of retracement or pullback or consolidation happening around the 4,500 point handle. So looking at the MACD indicator, both trajectory of MACD line and the SIG line is still projecting upwards. However, we see that the MACD line, the black line over here, might be plateauing and probably may be going sideways, and hence the gap between the MACD line and the signal line may start to converge going into next year, and that is a sign that maybe there might be a change in direction then. Okay, so probably next year, once we reach the peak and we do not have any catalyst to break upwards, we might consolidate further or retrace further, and hence the narrowing of the gap between the MACD line and signal line, showing that the upside momentum that we see during the November period may be subsiding already. So RSI has already breached the overbought mark of 70 points, now reading at 71.55. The previous time where we saw the RSI hit above 70 was in July, as well as the June period. So once it hit this period, you can see a small pullback in the June period. Once it hits the July 74 points level, after that, we can see that there is a significant retracement where when we hit the year-to-date high, we retrace back to the level of about 4,300 points. So right now, both of the indicators are showing that the S&P 500 may be a bit toppish right now, and the upside that we are looking at, about 50 points upwards, may not be worth the risk if a retracement is going to happen. And the index points right now, 4,559 points, sitting just slightly above the 4,500 points, may likely be the pivot point that we are looking at, or the target that we are looking at going towards the end of the year for S&P 500. So limited upside there, and then there might be a possible chance of a consolidation. So not much of a margin that I would say for traders to look at going to end of the year. Lastly, let's look at the Nasdaq Composite Index. So Nasdaq Composite Index, let me see. So let me just clean up a bit of my chart, delete this away. Okay. So as the Nasdaq Composite Index closed at 14,250 points last Friday, and the year-to-date high is around this level over here, which is the 14,446 points. So we are about 200 points away from the year-to-date high. So that is also the target that we are looking at moving into the end of December. Of course, if you are a trader, you trade on a daily basis, then probably you might still have some kind of scalping opportunities towards this target of 14,446 points. But if you are a swing trader or maybe a longer term investor, you might want to look for a position or a trade setup that is more in your favor in terms of the risk and reward ratio. Okay, so MACD indicator looking at a bit of a converging between the MACD line and the signal line. So that means that the upside momentum we saw in November is subsiding. So we are not saying that downside is going to come in because we don't have a crossover yet. A crossover would signal a change in direction, but now that we are only seeing the converging of the MACD line and the signal line, it means that the upside, the uptrend momentum is subsiding right now. So the upside momentum is still there, but it's weakening right now. On the RSI, the latest reading we have is 68, just 2 points below the 70-point overbought mark. And the recent high that we saw on 20th November was at the 71 point. So if you look back into history this year, we can see that some of the high points that the Nasdaq Composite Index touched was at 78 during the 15th of June period, as well as the 75.8 reading somewhere in the July period. So when we hit these two periods, we expect some kind of pullback happening, whether it's a small one or a larger one that we observed in July. So now that we have crossed above 70, we should be wary and look out for some kind of pullback or retracement. And that might happen, like I said, if we retest the year-to-date high, 14,460 points, there we might have a bit of pullback. And the support level to look out for, the double top over here during the June and July period at around the 13,900 or 13,890 points level might be a good support level to look at. And at this level, we also see that the moving average, the green line here, which is a 20 days exponential moving average, might come in to provide further support. On the uptrend that we see on the Nasdaq Composite Index connecting the low of December and March this year, we have the long-term uptrend line. Of course, we have a breakdown over here, but this line may also provide a bit of support for the Nasdaq Composite Index during the going to the end of this year for a consolidation period. So I think most of the index upside has been priced in right now, especially for the three major US indices. So I don't think I'm going to take any further position going into the end of the year for the three major US indices. On the STI index, I think we are going into a consolidation mode as well. And I think we are going to finish around the 3,100 levels. So I think I'm pretty much done for this year. Any final thoughts, Gerald?
Well, I think everyone is just looking forward to the year-end holidays. But we can also just make use of this opportunity to refresh ourselves, learn a bit more about how we can become a better investor, and then prepare for the year that is coming up ahead. So hopefully, as we go into December, that is something that we have all maybe marked some time in our calendar to be doing, so that we can really come back in 2024 and be better prepared.
Yes, better prepared and better equip ourselves with all the trading tools, strategies, and skill sets that we can acquire to make ourselves a better investor. So just a reminder here, next week or the month of December, I will be clearing some of my annual leave, and Mr. Gerald has kindly stepped up and agreed to hold on to the default here on the weekly market review. So don't be surprised if you don't see me. You will still see Mr. Gerald Wong over here on Monday weekly market review to get you updated on what's happening in the market. And tomorrow I'll be moderating the elite commercial REIT presentation. So I'll see you again on tomorrow. And in December, we have our SIAS, the final one on 13th of December. I will be there as well. So you will still see me on and off in December, just that on Monday itself, I will be trying to extend my weekend, going to the end of the year to take some trips around the region. So I think that's all the time that we have for this week. So as usual, his name is Gerald. My name is Sunny, and we'll see you again next week in the next weekly market review.